here, I was bringing your keys.
Oh, this is for Zani, the fox. I took it last when I was visiting.
Oh, I wondered whose forks they were.
It's for Zani, my God.
There's a parcel in your in the library. Chantal said somebody delivered it.
For me?
No, it's for one of the students.
Okay, I'm gonna check it.
Yeah, goodie. They might come and ask you for it.
Okay. Thank you.
Okay.
it's a one-on-one. Okay. Morning, everyone and everyone at home. Donna did a video for the class. It's uploaded, or it will be uploaded to the LMS regarding the other engagements. So I'll just be doing the tutorials. For those who haven't seen yet, she's also done the test review. So you can go have a look at that, work through that and see how that went. What I want to start off with is first showing you guys a little bit on how to flag King in the Companies Act, because I know everyone is a little bit lost and they don't know what to do. So I'm an overflagger. I flag a lot. But what I basically do is I read through King the first time and I said, okay, what do I think is important and what could possibly come up? And then afterwards, what I did was I did a few questions and then I saw, okay, what is tested regularly and what comes up often? And then I went back and I flagged that again. So for instance, the moment that they asked me about the composition of the board, I can immediately open at the composition and I can see what the composition of the board should be like. I don't over highlight because then everything on the page looks important to you and you're not really going to know what is actually important. So try not to over highlight. What I did with Companies Act, you can see it's also color coordinated. But what it comes down to is that there's a document on the LMS and it's called the SACA Competency Framework. So this competency framework actually shows you a little bit more of how in depth you need to know your Companies Act, and also groups your sections together for you. So for instance, if I start from the start, you can see it's blue and then it's purple, and all of this is like grouping together what goes together. So underneath here in the purple, I basically had everything that had to do with company records and company documents, and then everything in green has to do with shares. Then if I flip over, all the pink has to do with the minutes of the meetings and the proxies, and then the directors. So I basically grouped everything that goes together to help me on the day that if they talk about meetings, I can quickly flip it open and find it. Okay. So the first tutorial that I'll be looking at is 7.16. So I'm not going to read the entire scenario to you, but what I will be doing is I will be highlighting the important portions of it. You know, I try and go through all the tutorials with you rather than spending all the time on one tutorial, because then we cover a little bit more base. And in that way, I really don't have the time to read the whole scenario to you, but I will spend time on actually explaining the parts that I think is really important and showing you where in your books you can find this to help you navigate through that. Okay, so with this question, it's innovative technologies. Okay, 7.16. Okay, so the first thing that I want you to see, basically in the fifth line from the bottom, they tell you that they have 3 executive directors and 4 non-executive directors. So, as you know, King tells you what the composition of the board should be. And what does King say? King says that there should be executive and non-executive, with majority of them being independent. And if you don't know where to find that, you need to flip to your King, open principle number 7, and you will see point number 8 says the governing body should comprise a majority of non-executive members, most of whom should be independent. And in this case, they told you there's 3 executive and 4 non-executive directors. So in this case, they're still fine. They're complying with King Principle 7. Okay. Then if you look at point number 2.1, they tell you, with effect from March 2020, Thabo Modise, a leading political figure, would be appointed as chairman of the board of directors and would also assume the role of director and human resources and transformation. So what do you know about the chairman? What should the chairman be? Okay, well done. So the chairman should be independent and non-executive, and he can't be involved in any of the other positions because he's not, then he won't be independent and non-executive, okay? So that's the first thing. Then if you look at point number 2.2, they tell you new SA would be given the right to appoint 2 new non-executive directors to the board. Okay, so whenever they tell you that someone can appoint the directors, you always need to ask, in terms of Section 69, is this person maybe disqualified to be a director? Okay, so if you go look at the Companies Act, Section 69, they do tell you who can actually be a director. The other thing is the board should still have an appropriate balance of power. And if New SA now has the right to appoint these directors, don't you think that they would use their judgment to their benefit? So they would appoint someone that might not be independent, might not be non-executive, and eventually the composition of the board might be incorrect. So whenever there's a new appointment, you still need to go back and see, okay, is my composition of my board still okay now? Because what if they appoint 2 executive directors now? Then we're sitting with a balance of executive and not non-executive. Okay, so you'll have to have a look at that. Then in the paragraph just below 2.2, they say, it was also noted at the meeting that Innovative Technologies Limited, largest individual shareholder, Paul Pretorius, holding 36% of the company's issued share capital, agreed to sell all his ordinary shares to an empowerment company, New SA. Okay, so if you sell majority of your shares, what is this? What type of transaction is this? So we look at section 117 and 112, where we look at mergers and acquisitions, same as MANAC. So what basically happened here, it's called an affected transaction. You are disposing of majority of your shareholding. So the moment that you see this, I want you to go and read, have a look at section 117 and section 112, where they talk about the takeover regulations. Okay, so I think that's quite important for you to have a look at. Then in the third paragraph from the bottom, they talk about the board unanimously accepted Sam Smith's proposal. Shortly after the meeting, the 3 independent non-executive directors, including the chairman of Innovative Technologies Limited, agreed to accept the 100,000 offers and resign. So, you know, in the Companies Act, they talk about the nomination committee. And the nomination committee needs to ensure that the process is fair and transparent. Whenever they appoint someone, it needs to be fair and transparent. And the fact that they unanimously accepted his proposal means that was there even consideration given to the fairness and the transparency of this? Okay. Then in the second last paragraph, they talk about in anticipation of the deal being announced, Sam Smith, a chartered accountant, increased his holdings in Innovative Technologies Limited by acquiring 10,000 shares on the open market. Whenever you see there's a chartered accountant, what do you need to think of? CPC, well done. The other thing that they're telling you is in anticipation of the deal being announced. So Sam acted on information that was not public yet. He used that information to enable him to get an advantage. So what does that mean? What is he busy with? Insider trading, okay? And that's illegal. So if you want to read up a little bit more about directors' liability, go look at section 77 and 78 of the Companies Act, okay? Then on the next page, point number 1, they said Mr. Modise should be paid his full gross annual salary for the 12 months to October 2021 in the amount of 2.5 million in October 2020. If you get paid a salary, do you get the full amount or do you get the net amount? The net amount. So if they're paying him out the gross amount, don't you think the tax, what about the tax? They're not complying with the tax regulations because they should be deducting his pay as you earn. Okay. The other thing that this appears to be is a financial assistance because they're providing him with his salary in advance worth 2.5 million rand. So you need to go and consider, does the memorandum of incorporation actually allow this? Does the memorandum of incorporation maybe not say, you know what, we can't give anyone their salary in advance because what happens if he resigns or he disappears with the 2.5 million rand and you haven't received the services yet? Okay. The other thing that you need to think of, this is a significant amount of money to just pay out. And after paying out this money, would they still meet the solvency and liquidity test? Okay. So whenever you see financial assistance, there are basically 2 things that I need you to think of. You need to think of, will they meet the solvency and liquidity test directly after this transaction? And the second thing that you need to think of, was a special resolution provided within a period of 2 years before this financial assistance being provided? Okay, and you can have a look at section 45 for that, okay? Then There was another thing in section 45 that I wanted to highlight to you guys, because I don't think a lot of you actually know about this. But if you open section 45, paragraph 5, there is a portion that I just want to read to you that you need to be aware of. So basically what it tells you is when you are providing someone with financial assistance and this value of this financial assistance exceeds 1/10 of 1%, so basically 0,001, okay? If that value of the financial assistance that you're providing to someone exceeds 1/10 of 1% of your net worth of your company, you've got 10 business days to report this or to inform the shareholders and the boards and everyone about this. If it doesn't exceed that, you've got 30 days. Okay. So take note of that. We don't always give you the values and say, okay, the net worth of the company is this much, and this is how much the financial assistance was. But what we need you to know is consider it. Even if we don't give you figures, tell us that if it exceeds this much, they need to tell us in 1 day or in 10 days. Okay, so be aware of that section. It is something that not everyone is aware of, but it's an easy mark to get if you're aware of it. Okay. Then in point number 2, they say an amount of 7.5 million should be lent to New SA. So once again, this is financial assistance, and your solvency and liquidity tests need to be met. Otherwise, you will be busy with reckless trading. Okay. So make sure that whenever you see we are giving someone money or giving someone anything, we need to make sure that we will still be able to meet our solvency and liquidity tests. Okay. Then they say, in order to facilitate the interest payments on the loan, Mr. Modise should, for the next 5 years, be given a minimum annual performance bonus of 1 million. What is a performance bonus based on? On your performance. So if I say, okay, no, we're just going to give everyone 50% to walk into the exam with, is that fine? No, it's not fine. Same thing, they can't just say, okay, for the next year, we will be giving you a 1 million rand bonus just because. It's based on performance. So they are basically having to consider the remuneration committee here. And the remuneration committee, if you go read up in the King, tells you that the remuneration should be fair. And you can't pay the directors 50 million rand in 1 year and the rest of the company is struggling. Okay, so basically saying that you can't just say, okay, it's a performance bonus, we're giving you 1 million rand for free without assessing your performance. And that's also where you can go have a look then at section 45.5, where I told you about the 1/10 of 1%, okay, of the net worth of the company. Okay, so then that's basically that part. Then point number 1, where they talk about the following. They say, during the board meeting, the following also took place. Sam Smith, the chartered accountant, tabled the report to the auditors, the company's internal auditors, evaluating the effectiveness of innovative technologies, risk management practices. The audit firm of, I'm not going to say that name, also acts as the company's external auditors. Can someone be your internal and external auditors? No. And if they are, what needs to happen? So there's some sort of threat happening here, an independence threat, a self-review threat. So how can we mitigate that? Maybe saying, okay, A and B is part of the internal audit team, and C and D is part of the external audit team. So having separate team members, if they really have to do this, it needs to at least be separated. The other thing that I wanted to ask you, whose responsibility is it to evaluate the risk of the company? The board. The board's responsibility. And if you go look at Principle 7, they should be having ongoing oversight. They can't say, oh no, we need the auditors to come in to evaluate our risk, because they should be ongoingly assessing the risk and ensuring that it is at an acceptable level. Okay. Then under point number 3, they told you 3.1, while it was agreed that the fee was reasonable for this type of engagement, the external auditors would be instructed to use the findings of the risk management review for their external audit in order to minimize the external audit fee. Do you think that the client has the right to instruct management or the auditors on how to audit and what should be audited? No, they don't. So in terms of the Auditing Profession Act for the JN intake students who would have gone through this already, or from last year, and the June intake students, Section 44, it says the audit should be conducted in a manner that is free from any restrictions. And if management is telling you that you have to use the assessment that you did in your audit, they are not providing you with access to all the information. They are imposing a restriction, which could lead to a scope limitation. Okay, so just consider that. The rest of it, I think if you just have a look at it and look at the memo, there's nothing major that I think needs explaining. However, part B I quickly want to discuss with you, and it talks about outline the matters the directors of the auditors would need to consider before accepting the engagement to enhance the creditability of the client statements about BBE charter compliance. So what I try and do with client acceptance is I try and bring it a little bit home. Instead of you guys thinking of, wow, what would an auditor think of? What would an auditor consider? Wow, I've never been in auditing, I don't know. So what I like to do is think of Gary, okay? Gary running his institution, IAS. And you guys coming to him and say, Gary, I please want to be your student. Aren't you his clients? Yes. So what does Gary consider? Gary thinks of, okay, do I have the resources? Do I have enough tables? Do I have enough books? Do I have enough lecturers? Do I have the knowledge to actually teach these students in the appropriate manner? Or am I giving you a matriculant who's teaching you auditing who's never seen auditing? Okay? So that's what you need to think of. Can he actually service this client? The other thing that he thinks of is your reputation. He thinks of your reputation. He thinks of your undergrad marks. Will you actually be able to pass? Do you have the appropriate knowledge and skills to pass? So what is this linking to in the real life business now? The engagement letter. Will you sign the engagement letter? Are you actually someone he wants to be associated with? Would your reputation affect his reputation? Think of it as an auditor. Would you like to audit a strip club? It's going to be a very awkward situation for you because do you really want to be associated with that? Someone needs to audit it, right? So someone is thinking that, yes, okay, I'll audit the strip club. But in a lot of companies, they've got a level and they say, okay, we don't audit this or we don't audit that because of this or the risk. So he also considers the risk. If he accepts you and you haven't passed your degree, that's a risk for him. And that's not legal. So he also needs to consider the legal implications. Can he actually accept you? Do you have a degree? So in the case of a company, what do we need to consider? Can you actually be the auditor? Is there maybe another auditor in place? So the moment that an auditor is discharged or is no longer the auditor, how many days does the company have to replace this auditor? 40 days. Have a look at the Companies Act, Section 90. Okay. So that's the one thing that you had to think of. And the other thing with the engagement letter, right? So when you come to IAS, Gary says, okay, we need you to attend lectures. We need you to do your tutorials. We need you to consult. We need you to write all the tests. We need you to do this, that, and the following. Don't you think that's similar to the engagement letter? You saying that, yes, I will accept to do all of this. I will attend tutorials. I will listen to the lecture. I will consult. I will email. And same thing in the engagement letter. Management has to accept their responsibilities for the audit. Okay. The other thing that Gary thinks of is, will you actually pay him? Or is he conducting a service for free? Is he being a non-profit organization? So that's one thing that auditors always consider. Will this client actually pay us? Are they in a financial position to actually pay us? Okay. And then also he considers the purpose of the engagement. Is it reasonable? So the purpose of you being here is passing your CTA. And that is a reasonable purpose to be here. But if your purpose for being here is sitting here and eating your KFC ice cream and chilling the whole day, and then 5 o'clock you quickly open your book just because the purpose is actually to study, don't you think that Gary would rather be like, the purpose of this engagement is not right? Okay, so think of that in a business perspective. Let's say that they say, we want to do a compilation engagement or a review engagement, but in terms of their company, the memorandum of incorporation says they need to be audited. Is it reasonable for them to do a compilation or a review? No. Okay, so just to bring it home a little bit, next time you see pre-engagement activities, think about Gary and what he thinks of, and then just link that back to the business. Okay, it helps to bring it home a little bit. Okay. The next one that I will be looking at is case 8.4. Yes. So it doesn't necessarily trigger a merger, but we're going into that section. So once you get to, are you Jan intake? Okay. So once you get to management accounting, mergers and acquisitions, you can see that those sections in the Companies Act you can use for mergers and acquisitions. So it doesn't necessarily trigger a merger, but what it does is it takes you into disposing of a major part of your business, because selling 36% of your shares is considered to be a major part of your business. So then there's resolutions and there's all these things that you require. So it doesn't necessarily take you into a merger and acquisition, but it takes you into the takeover part of the Companies Act. Okay, does that make sense? Okay. Okay. So with this one, case 8.4, I quickly want to do substantive procedures with you first. And without having a look at what they told us in the scenario, I just want to chat about it, just get that fire sparked and start thinking about what do I do in any substantive procedure situation, because I know the moment that students see substantive procedures, they go blank. And they're like, I don't know what to do, I don't know where to start, I don't know what to say. And I think we should just cross that barrier and make it a little bit of a homey feeling. So when you go to your clients and you need to audit, let's stick with the loan that they're auditing, what's the first thing that you ask management for, or that you obtain from management? Same? You get a schedule. First, ever. You get a schedule from management. Now students are like, but we don't actually know what a schedule is. Do you know what Excel is? You know what Excel is. You've worked on Excel. So basically what a schedule is, basically management taking the figure in the trial balance or the general ledger and the annual financial statements and setting up a little schedule for you and saying, okay, I've got 100 Rand in my revenue. What it consists of is 20 Rand for books and 70 Rand for glasses and 10 Rand for pencils. That's basically what it does. The schedule just summarizes everything for you. Okay. I will slow down a bit. Okay. So now you've gotten your schedule, okay? But what are you giving your opinion on? The financial statements. So don't you think the first thing that you need to do after getting the schedule from management is to reconcile the schedule to the annual financial statements, the trial balance, and the general ledger? Because what are you giving your opinion on the annual financial statements? And what is that obtained from? From the trial balance. Okay. So then you go into your general procedures on the schedule, and you cost and you cross cost. And basically the only thing that cost and cross cost means is that you're going to add up everything sideways and make sure that it makes sense. You're going to add up everything upwards and make sure that it makes sense. It's just making sure that the calculations are making sense. Then you're going to reperform all mathematical calculations. So let's say, for instance, I said that we sold 7 glasses or 70 glasses at 1 Rand each. I'm just going to say 70 times 1 is 70 Rand. So you just make sure that the calculations in the schedule is correct. Because anyone that's worked on Excel knows how easily you make a mistake. How easily do you say 1 plus 1 rather than saying 1 times 1? Mistakes happen really easily. And let's say you have to add up everything upwards. You might miss the first column or the last column. Or the last line. So just make sure that everything in the schedule is okay. And that's the general procedures. And then you start going into, is my presentation correct? A general procedure. Is my, can I maybe get a management representation from them? Okay? Because that's the general procedures. You can always do them. Can you maybe inspect the minutes? The easy procedures, the ones that you can use for anything. You can see that doing those procedures is not specifically linked to the loan. It's linked to procedures in general. So then I have this theory that I'm going to write on the board for you guys, and it's to help you guys just word your substantive procedures correctly. Because students come to me and they say, but Chantal, I wrote what you wrote. You said obtain a schedule from management and perform the following procedures. But then you wrote in your test, get a schedule from management. And sometimes you're on the right path, but your wording is just not correct. So I've got this theory that I used, and it's called the 5 bums on a bench method. And it works like this. So it says who, what, when, why, and how. Okay. So I'm going to do a substantive procedure with you now so you can see how my wording fits into the schedule, okay? So the verb is always your how, your verb that you get in your ISA, okay? That's always the how. So let's say we are going to obtain the schedule now. We say obtain a schedule regarding the whatever you're busy auditing in our case. Let's say obtain a schedule regarding the loan account for the year ended, whatever your year end is, from management. You don't always have to have all of them. Okay? And why are you doing this? So what you can then do is you can have a specific procedure, like then say, and select a sample and corroborate to the loan agreement, or you can do your general procedures and you can say that you are going to cast, you're going to cross-cast, you're going to re-perform the mathematical calculations. So can you see that if your substantive procedure is worded correctly, it's gonna sound correctly. So let's say, for instance, what you're going to do is, by virtue of using computer-assisted audit techniques, select a sample of loan transactions. What are we selecting? Sample of loan transactions, and inspect the loan agreement. So what are we doing? We're inspecting the loan agreement. For what? What are we inspecting it for? Let's say, for instance, we're inspecting it for the values or for the repayment terms or maybe for the validity thereof. Did both parties sign it? So can you see that if you're going to word your sentence correctly, your marks are going to come easier. So you don't necessarily have to have all of them, but if you at least try and have most of them, you don't every time have to tell me that you're going to get it from management. Okay? But if you at least maybe address the other four and say that you are doing this to do this to ensure this, you'll get your marks a lot easier. So that should help you a little bit with wording your substantive procedures. Okay. Okay. So then just a little bit more detail on the substantive procedures of the loan. So now you've done your specific procedures, right? Now you go into your specifics. You've done your general, you need to do specifics now. And specifics is specifically on what you are busy with. So, for instance, what can you do? You can obtain the loan agreements for a sample of loans. You can re-perform the calculations in there and then corroborate to what management has. Because let's say management says the loan is 100 Rand, but meanwhile, based on your calculation, it says 50 Rand. Now you need to reconcile that and determine why there is a difference. The other thing that you can do is maybe perform an external confirmation. Maybe select a sample of employees that you have a loan with and perform an external confirmation. Ask them to confirm the balance. And that's just some of the things that you can do. I think one thing that you guys maybe do not know, in your ISAs, at the back of your ISA, there's a special consideration section that has substantive procedures, basically the entire audit process on how to audit financial instruments. And a loan is a financial instrument, isn't it? So if you got this question in the test, you would have been lost. But maybe knowing a little bit of where everything is in your ISAs could help you on the day. I'm not saying don't study and just rock up with your ISAs on the day and say, I'm going to be 100% fine because everything's in my ISAs. It's not going to work because your application thereof is going to be wrong. But knowing your ISAs and knowing how to use it on the day does give you a little bit of guidance and help on the day. So maybe go have a look at that. I can't tell you exactly where it is. I don't have a book here. But it's at the back of the ISA book. And in that, they tell you what you need to consider when auditing financial instruments, the substantive procedures, all of that. So go have a look at that. It will give you a little bit of guidance on that if you would like to know a little bit more of that. Then the next question that I'm going to be doing as part of 8.4 is number C. And they said, discuss any ethical or corporate governance concerns other than those dealt with in parts A and B above, relating to Homely Holdings Limited and its directors that arise having read the information provided. So what I'm going to do is I'm going to take you through the scenario again and show you what you need to look out for and what you need to consider. Okay. So the moment that you see they're telling you who the directors of the company are and who's part of the board, what do you need to consider? The composition. So you have a look at them and you evaluate how many of them are executive and how many of them are non-executive. So one thing that I need you to look out for is we like to confuse you. We like to say, this is the human resource manager and he is non-executive and independent. Is that possible? Isn't the human resource manager the person that everyone goes to and complains to about the boss and all of that? So the likelihood of him being independent and being non-executive is very, very, very low. So just assess that. As well, in this case, it didn't happen, but I'm warning you from experience. Then if you look at Mr. Anthony Africa, they say that he is the financial director and the company secretary. He can't be both. He can't be both. Have a look at, I think the secretaries are from section 85 to 89 in the Companies Act. Read up a little bit on that, know what they are allowed to do, what they're not allowed to do, because that can help you in a situation like this. Then, at that bottom paragraph, they talk about executive directors have employment contracts dealing with salaries, benefits, and performance incentive payments. Each non-executive director receives a base fee plus fees for attending meetings of the board and its subcommittees. What do you think the remuneration committee would say that if we pay someone based on their attendance? Let's say I gave you marks based on your attendance. Is that okay? No. So basically what they need to think here is it fair, transparent, and reasonable? Is this fees that they're providing them? Don't you think they would just want to have regular meetings now to increase their fees? Okay. What else does King tell you about meetings? They tell you that meetings should be conducted on a regular basis to ensure that the board can complete their functions and their duties efficiently and effectively. And sometimes you need to watch out for the dates. So in this case, it didn't happen, but I'm warning you what can come up. Look out for the dates. If they say they only do 2 meetings a year, if you only come to class 2 times a year, do you think you'll be able to pass? No. Same thing with the board. So they won't be able to perform their duties efficiently and effectively. Okay. Then in the last sentence, or the second last sentence, they tell you they have an audit committee consisting of Mr. Howard, chairman, and Mrs. Shetty. So in terms of the audit committee, how many members should they have? A minimum of 3. They only have 2. Okay. So basically what King says about the audit committee is collectively they should have the necessary care, skills, and competence. So if they only have 2 members there, do you think that they have sufficient staff in that audit committee to perform their duties? No, because they say in King that you at least need 3 members, and between these 3 members you need to have the adequate skills and competence. Okay, and it's not likely that they actually do have that. Okay. Then on the next page, in that middle part where it's a little bit cursive, they say, you must be more accommodating of our needs when it comes to the external audit of HH. An external audit is, after all, no longer a statutory requirement. Specifically, we want to inform the audit team of the accounts balances they should devote their attention to. Rather than having your team audit all the account balances, are you willing to agree to this? So they do also tell you in that sentence that those account balances that we suspect may be materially misstated. So once again, are the clients allowed to tell you what they want you to do? No, because they're basically restricting you and informing you where they want you to devote your attention. But on the other hand, don't you think that management knows their company best? They do. So don't you want them to inform you, but then you make your decisions? You are still independent of them, so then you go and you set up your plan. Okay? So yes, it does help to have management's inputs on that, but they can't tell you, okay, no, you have to spend your time here, or you have to spend your time there. Okay? So just watch out for that, because in the end, the other thing that I saw here is, after all, no longer a statutory requirement. Is that true? Is there no statutory requirement for a company to be audited? No. When must a company be audited? When the public interest court tells you so? Or go have a look at Section 30 of the Companies Act, where they tell you a public company must be audited. Okay. The other thing is, if you look at Section 29, they tell you that the financial statements may not be false or misleading. And if the auditors are not going to be auditing all of it and they're merely going to devote their attention to where the client says, don't you think there might be material misstatements in the other accounts? Because think about it logically. If I come to you and I ask you, dear management, where do you think the financials are misstated? You're going to tell me, no, there's no misstatements. We don't have any misstatements. Do you think management is going to tell you, oh no, we actually stole some money from the petty cash, but you can just go have a look at that? No, they're not going to tell you where they committed fraud. They will tell you where they think someone else might be busy with fraud, but they're not going to tell you where they're committing fraud. Okay. So just remember that the auditors should conduct their audit in terms of the IAS. And later on, they ask you in one of the questions, do you think that the auditors have acted negligently and that the auditors will be kept responsible for this? Because you know that the auditors go and they audit the financial statements. Management uses that to obtain financing from the bank, or they use that to get a purchase price, or they use their financial statements. And there are third parties relying on those financial statements. So basically what they're saying is that, let's say there was a mistake in the financial statements and the auditors didn't notice this. Would the auditors be held responsible for this? Yeah. No, it depends. So if you go have a look at the APA and you have a look at limitation of liability section 46, they tell you that the auditors will only be held responsible if they conducted their audit negligently. So if they had the intention not to pick up the misstatement, or if they didn't do the audit in terms of ISAs, then yes, they can be held liable. But in general, no. So the other thing that you also need to think of is they can be charged with improper conduct if they don't follow their ISAs, because now they're just doing what management says. And if they're just doing what management are saying, they are not addressing all the situations that could possibly occur. Okay. So you can have a look at the limitation of liabilities. I think it's one of those sections that you need to use your judgment as well. If they tell you that management only tested the glasses that they sell and not the books and the pencils, do you think that that would be reasonable? If the auditors just said, we're just testing glasses, we're not testing anything else. So you see, you have to use your judgment and say, but they have 6 other revenue streams and they're only testing one. Maybe all the issues are lying in the pencils revenue stream. So they have to consider all of them. And that you can use your judgment on. In our RTC, we had a question, and I can't remember exactly what it was about, but they basically told us that we are only testing this one material account. We're not testing all the other small accounts. And in the end, what happened was, in all the other small accounts, there was basically fraud happening, and they were manipulating the information. And some third party wanted to sue the auditors and say, but you conducted the audit, why didn't you pick this up? And they wanted to say, but no, we focused on the material one, on the one material thing that happened. But just focusing on the material thing won't necessarily give you an opinion that is correct. Because like I said, all the other small misstatements together can have a material misstatement. Okay, so sometimes you have to use a little bit of your judgment in that regard. Okay, then what they tell you is, yes, if they don't conduct their audit in a manner that represents the ISAs, it's negligent. Okay, so let's say, for instance, they realize that the company is making losses, okay, but they're not performing any procedures on going concern. That's negligent. Okay, so if you don't conduct your audit in a manner that represents the ISAs and the acts, then yes, it's negligent. But negligence won't necessarily be because you didn't test the thing. Remember, fraud is done intentionally. So you might not necessarily pick it up. But if you have conducted your audit in an appropriate manner and you didn't pick it up, it's not your fault. It happens. But you still need to be conducting your audit in terms of ISAs. Okay? Because if it's not, then it's negligence. Because the ISAs basically address everything that could possibly happen, that they are aware of. Obviously, there can be a situation where something odd happens. I was in practice and we were auditing, and we had this situation where we didn't pick up fraud. Okay? But what happened was we were testing revenue. Okay? And you test all the revenue invoices and you corroborate the bank statements when they pay you, and you check the debtors account, and you literally do all your procedures in accordance to the IAS. But if management has a separate bank account and they issue invoices externally they generate them on Excel, and when they're done, they delete them, do you think you'll ever pick that up? They're paying into a separate bank account. Invoices are not in your company's books. Will you ever pick that up? No. So even though we conducted the audit in a manner that is in terms of, you will never pick that up. Yes, so detection risk comes in there, but you would never pick that up. You didn't know. Because how would you know if they have a separate bank account, they do Excel invoices, everything's happening outside of your books, it's on the sideline, but they're selling company stock. So it's quite a sticky situation on evaluating the negligence, because that wouldn't have been negligence. All the ISAs have been, you've done your audit in terms of the ISAs, but because fraud is done in a manner for you not to detect it. So that's why you change, where they say you need to change your audit approach every now and then. That's where you change your approach, because the management gets used to how you audit, and by you changing your approach, and that's why we picked it up, changing the approach. So that's what you need to see, is that even though you did your audits 100% in terms of the ISAs and you weren't negligent, something could occur. But if you were negligent and you specifically did not test the going concern assumption, or you specifically did not test this or that, it will happen that you would be caught negligent, and then you will be charged of improper conduct. Okay, so just be aware of that. Then, under point number 1, they say, in August 2019, HH acquired a 60% shareholding in Curtains Emporium. HH instructed the board of Curtains Emporium to make the following amendments to the company's memorandum of incorporation with immediate effect. So if you make amendments to a company's memorandum of incorporation, don't you think it's a process? You'll have to file a notice of amendment with a sub-C. And do you think it is fair to buy over another company and say, please change your memorandum of incorporation? For instance, in the one point they say, you will be granting all the company's loans. Is that fair? No. So the company will not be managed in such a way that they will be efficient and effective. Okay, so just watch out for merely making changes, and those changes might not be in the best interest of the company. Okay. The other thing is, you need to know that any changes that they make to the Memorandum of Incorporation must still be the same as what the Companies Act would say. Do you think that I can go and say, oh, the Companies Act says whenever I lose an auditor, I need to replace them in 40 days. But I don't feel like 40 days is enough. Let's just make it 60 days. Easier. Do you think you can do that? No, so it must still be compliant with the Companies Act. Otherwise, it's null and void. Okay. That's the other thing that you need to consider. Then point number I, they say Curtains Emporium Limited must be externally audited, and there's no problem with that. You can see that this will be a voluntary audit then, so it won't be a mandatory audit. So based on the shareholding situation that they have, they require them to be audited, and that's fine. It's just a voluntary audit, so not in terms of the public interest score, it's in terms of their requirements. Okay. Then the other thing that they say in point number 2 is that they should grant loans to HH Group companies when requested by HH and provide Curtains Emporium Limited solvency and liquidity position allows for this. So in terms of Section 45, can you see that this will be financial assistance, although this is not to a director, but still, whenever you have financial assistance, you still need to consider whether your solvency and liquidity tests will be met. And don't you think that if this company has to provide loans to the whole group, they would start running into problems? And the moment that you run into problems, what do you call that? Reckless trading. Because they're not going to be solvent, they're not going to be liquid, they're not going to be able to pay their own debts, but they need to grant people loans. Okay. So then point number 3, they say the requirements for a special resolution to be approved is to be reduced from the current 75% of the votes cast in favor of the resolution to 65%. Is that okay? It won't be in accordance to the Companies Act. And you can't merely say, oh no, we don't want 75% to actually agree, because there's always this one guy that's being difficult and then you don't meet it. Okay, so they can't do that and say, okay, no, we're reducing it to 65% because then we're outcasting those other people's votes. Okay, so just have a look at section 6510. That will give you a little bit more guidance on that. So then they also say Curtains Emporium Limited should make use of HH Audit Committee and internal audit function. So basically they're saying that this company should now also make use of the same auditors and the same internal auditors, which is not a problem. They just don't want the group to be audited by various different auditors and having all these different issues going on. That's fine. But the other thing that I'm a little bit worried about is if everyone in the group is making use of the same internal audit function, do you think that they would have enough time to do their duties in all these companies sufficiently and effectively? No, because they're going to be busy with all these companies, and especially because they're saying it's a group, there's going to be a lot of companies in this group. Okay. Then at the bottom, they say, at the 20 February 2020 board meeting of HH, Dr. Billings expressed the desire to step down as chairman because he wants to spend more time with his wife and grandchildren. He would, however, remain on the board as a non-executive director. He proposed that in line with the company's track record of success due to tight family control, his daughter, Jane Billings Carver, succeed him as chairman, while also remaining a chief executive officer of the company. Who's allowed to be the chairman? How should the chairman be? Independent and non-executive. And if Jane is the executive officer, do you think she's independent and non-executive? No, she's not. The other thing is, don't you think that this is nepotism? Does everyone know what nepotism is? So nepotism, for those at home, is basically if I say, you know what, my sister is a chartered accountant, so I'm rather going to appoint my sister because it's just easier, and shame. I want her to rather get the money than anyone else. And it's basically giving favoritism to a family member or to someone you know, rather than following a nomination process that's fair and transparent. So, yeah, the nomination committee should be like, sorry, but where's all the candidates? And it's not just one person of the board that should appoint them. It's the board as a whole that should assess them. So I think that's one thing that you can have a look at. The other thing from this, I'll be with you now, the company secretary, right? Go look at the Companies Act. I'm not sure which paragraph exactly, but it's between section 85 and 89, where they tell you the duties of the secretary. And the secretary's duties is basically to inform the company about any non-compliance and any irregular activities. And if the company secretary did not pick this up, do you think the company secretary is competent? No. Yes? Yes. You can definitely say, what the student asked was, due to this director just resigning last minute, there was no succession plan. So basically no plan to replace a key member of management. And I think in practice, you're not going to plan ahead and think, oh, what if my director resigns? Am I going to get someone else? Because you don't think that your director will just resign, okay? But in this case, he's also staying on as a non-executive director. He's not just disappearing. He's still going to be there. But yes, I think each company can have a successive plan, especially in the current economic environments where people are just leaving. People are taking every opportunity that's a little bit better for them. So yes, I think you could have mentioned that there was no plan, and if he decided to leave and they couldn't replace him, they only had a certain number of days to ensure that or to at least make sure that their board is still in the right composition. Okay, so you could have mentioned that. Yeah. No, you can't say that you would be independent. And there's actually something in King or Companies Act, I'm not sure where exactly it is, but they do say that if you have resigned from your position and you can't take on another position within 3 years and be independent. So let's say I was the financial director and I'm now resigning from that, and I'm just going into the CEO position or I'm going into the chairman position, I won't be seen as independent because I was just now in the financial department. Okay. Yeah. Yo. Now, I want to give you the right answer. Okay. So the student asked, if I have a family business, should I still consider nepotism? And yes, you should. You should, because even though the business is a family business, let's say, you see, I think the purpose of the business is a family business. So I think that's fine. But let's say you have someone applying for the position and they are more competent. Let's say your nephew or your son just got his degree, now he's going to be your financial advisor in your company. Don't you rather think you'll take someone who's been a chartered accountant for 5 years, has gotten experience, knows a little bit more? So it's a hard situation because this stuff happens in everyday life. My friend that I play golf with every day, he's an accountant. I'm just going to take him. Why do I have to go through an election process? Because where the problem comes in, let's say, for instance, I've been here at IAS for, let's say, 10 years, and now I applied to be the head of department of auditing. And Zani's sister is also an auditor somewhere. She's never done lecturing, and she says, oh, no, I'm just going to take my sister because it's just easier. It's my sister. I want to give her the opportunity. There is going to be a nepotism situation going on here. So it is a very difficult situation. But I think in family-run businesses, it's an everyday occurrence. It's kind of, you're walking into a family-run business, and it's hard. I can't tell you according to laws because I don't know all of those laws and regulations, but I think it is something that you should consider at least, that if it is a family-run business, that's obviously the model of to let the company grow. But for instance, I know someone who works at a company and the boss's son is basically an accountant. So he's got his degree, he's got no experience, they've got a chartered accountant in the company. But what the father said is, if you want to be the accountant in this company, you need to start at the bottom. Go and first be part of the stock take team, then go and be a sales manager, and then go and do this, and then go and do this, and then you end up being financial manager, and then when that guy retires, you can be the chartered accountant. And that's the more correct way to do it, because you've sent him through the process. You can't just walk in and be the top of the company, So ethical, no, but it happens. That's that. I'm not a business advisor, so it's very hard for me to answer that question. But from my perspective, it happens. But the more correct way would be that approach, rather starting at the bottom and working yourself up, because then they can't say it was nepotism. Okay, so I think that's one thing that I would consider there. The other thing that I wanted to tell you guys is one of the principles in King says that you have to apply and explain. Okay, so last year with my test 2, we got a big King question, big, like 30 marks, and I thought, yes, I know King and I know Companies Act. I'm going to answer this really, really good, and I'm going to do so great in this question, and I never applied. I put down the principles from my book, and I never applied. So, for instance, if you know the composition of the board should be executive and non-executive, majority being independent, you know the principle, right? But then tell me that they are not complying with this principle due to them having 4 executive and 3 non-executive, and majority of them are not independent. Take it from the scenario and apply it, because you think you're applying, but you're not. So I had a student come to me and they did this. Principle 1, blah, 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 copy from King. And then they applied. Don't you think that's time wasted? Because you're not getting a mark for the copying. You're getting a mark for the application. So rather apply directly and say, the board consists of this and this. In terms of the Companies Act, this is not correct because it should be like this. Okay. So rather apply directly, because it is an easy section to get marks on. If you've gone through it, you know your triggers, you know your standards, it's an easy place to get marks. But the moment that you start not applying, you're losing marks. And it is hard because you don't always realize that you're not applying. When I got my marks back, I was like, wow. I was like, I knew King and I knew Companies Act, but I didn't apply. I'm just going to use my books on the day, and I'm just going to copy it and paste it, and that's not how it's supposed to be. Your books are there to help you. So you quickly flip open and you say, oh, 1/10 of 1%, and then it's fresh, but then apply. Okay. So don't just copy and paste from there because you're wasting time. You can bring scissors and Prit, cut it out and paste it there. It's easier. Okay. Okay, so make sure that you do apply everything that you are saying. Then the next question that I will be looking at is case 8.30. The one with the notes, Donna has done it, is on the LMS. So you guys can have a look at that one. I'm not going to discuss the ITC question, but it is on the LMS with notes from Donna. Okay. Okay, so case 8.30 is the one that I'm going to be looking at now. Okay, so I'm going to follow the same approach where I'll go through it and show you some of the triggers. The first thing that I wanted you to see was we're going to look at the minutes of the audit committee meeting held on 15 March. That document, it's on page 535 of the new book. So just look for the one where you can see the minutes. What is the name of the company? It starts with your name is Sam Claridon. Okay. Okay, so then I'm looking at the minutes. Okay. So the first thing that I want you to see is they are telling you who is actually representing the audit committee at this meeting. And can you see there's only 2 people from the audit committee there, and then there's one from the internal audit, and then the CEO is there. So without telling you a little bit more about this meeting, just have a glance at this first page and see how many times the CEO's name or the CEO comes up. You just stare at it and you see CEO, 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 CEO. Don't you think that the CEO, who's not even part of the audit committee, is a little bit too involved? His opinion is being voiced above everyone else's, and he's not even part of the audit committee. Okay. So have a look at that. Whenever you see someone who's not actually part of the audit committee taking over the meeting, that could be a situation of him exercising his influence with undue reasons, because he's not allowed to actually influence this audit committee. He's obviously part of this meeting for a reason, but he's taking the meeting over. No one else is saying anything. Then the other thing that I saw was Miss Pauline Pearson is the chairman, okay? They said it in the scenario. You can have a look at that later on if you haven't read the scenario as yet. And she's also the member of she's a member of the audit committee. The members of the audit committee should be independent, okay? And if she's the chairman, she is definitely not independent, okay? The other thing that I saw was there were all these people from different departments attending this meeting, but do you see anyone from the finance department? Do you see a CFO or a financial manager or anyone in there? So they had people from different departments attending this audit committee meeting, but no one from the financial department. Okay. Then that first paragraph, I'm going to skip that. I'm going to start there just above the 2 bullet points in the middle of the page, where it says the CEO added that he agreed to keep the matter quiet on conditions that Mr. Riddle resigns as CFO and leaves the company with immediate effect, and the 2 million misappropriated will be in full and final settlement of any amounts due to Mr. Riddle by LearnWise Limited. Do you think it's okay to keep a matter quiet? No. So what happened in this matter is, I'm going to read it to you so we're all on the same page. The CEO explained that following a tip-off on the company's whistleblower hotline, it was discovered that Mr. Riddle had misappropriated 2 million in July 2019 by paying the bonuses due to the company's middle management to himself. So instead of paying the bonuses to the people who had accrued to, he paid it all to himself. And then what did he do? He said, while these bonuses amounts were approved by the Remuneration Committee, Mr. Riddle wrote a memorandum to all middle managers indicating that due to the tough trading environment, no bonuses would be paid. He subsequently transferred the approved bonus amounts via the company's EFT system into his own account. So can you see that that's fraudulent? And they're willing to keep it quiet if he just leaves. And that's not okay, because this guy's going to walk into another company as a CEO and do the same thing. Okay. So in terms of PRECA, I don't know the whole name of the act. It's something about prevention and something about combating and crime. But there's an act that actually addresses this. And later in the year, when you do other laws and regulations, you'll see this act. And then you'll realize that this is crime happening and they're just hiding it. They're saying, oh, we'll keep quiet if you do this. Okay, and that's not okay. Then on that same thing, I want to discuss a fraud situation with you and how to answer the ethics question again. Because I know a lot of people in their test didn't do great in the ethics question. And I think if we just address this a few times, it's going to become a natural feeling for you to answer an ethics question. So the moment that you answer an ethics question, you always need to ask yourself, what's good for me? What's good for others? What's good for the company? Laws and regulations, ethicality versus legality. And if you go back to your test that you just wrote, go through the memo and see how I addressed each and every single thing in that memo. Well, I didn't do the memo, but my technique addresses everything in the memo. And in this case, let's think about it. What's good for me? He's stealing money. He's got lots of money in his pocket. He can go on a cruise. He can do whatever he wants. So it's good for him. Do you think it's good for the company? No, because what's happening in the company? Staff are demoralized because they're not getting bonuses. Don't you think that they would likely conduct fraud to get their bonuses or just pitch up late for work because the company doesn't care about them in any case? So the general atmosphere in the company is going to be demoralized. Okay. Usually the company and others could be the same person, or me and others could be the same person, but you at least need to address two of them. Okay. Then laws and regulations. I think in this case, it's hard to say specific which laws and regulations, but it would be unethical in the first place to do this and illegal because you are taking money that does not relate to you. You didn't work for that money. You're merely taking someone else's bonus and putting it in your pocket. So can you see how you can address ethics in this situation? I think trying to explain ethics to you guys on this small scenario is a little bit hard because I didn't give you more detail. I didn't give you more detail about who was supposed to approve bonuses, who was supposed to pay the bonuses, because here it also seems like the control environment is weak. And that is management's responsibility to ensure that all the controls are operating effectively for them to be able to prepare the financial statements. Okay. Yeah. Yes. So the student is asking that they tell you here that the audit committee noted this information and commended the CEO on handling the difficult situation so professionally. So this is the audit committee, it's not the auditors. Who reports? So she basically asked, can you say that the auditors also did not report a reportable irregularity, but it's not the audit committee's responsibility to report a reportable irregularity, it's the auditor's responsibility. So just remember that no clerk can be reported by anyone, or financial manager in the company, or whoever. But reportable irregularity must be identified by the auditor. Okay. So yeah, that's that. Then they said that the 2 million misappropriated will be in full and final settlement of any amounts due to Mr. Riddle by LearnWise Limited. What would the remuneration policy be on this? Is the remuneration committee okay with this? Are they fine with it? You need to ask yourself this. Did they approve this? Has it been accepted? The other thing is, it's full and final settlement of any amounts due to Mr. Riddle by LearnWise Limited. So he's basically repaying his debt with his salary. But he's not getting that salary. Shouldn't they declare tax on that? Because he still basically got that amount. He would have been paid that amount and he would have paid it back to us. Okay, so just watch out for situations like that. And all of this just tells me that the IT and internal controls are weak. What did the audit committee do? Didn't they assess the IT environment, the control environment? Because he had the opportunity to manipulate information and no one even noticed. Okay. And then we've got another situation here where someone just appointed their own nephew. That's the same discussion in the previous one because they're telling you that the CEO explained that the process of filing the CFO vacancy commenced almost immediately, as it was clear that there were no suitable internal candidates. A personal agency had been contracted to find a replacement. He was, however, not satisfied with the candidate selected by his agency. The CEO coincidentally noticed that Mr. George Gray, his nephew, a recently qualified CA, had returned from London after being employed in the United Kingdom in various temporary financial positions. So they just want to appoint him because it's his nephew. So once again, they didn't think of performing a background check. They just appointed him. This could be nepotism. But in this case, they at least first tried to get someone else, and then they went to that. But that kind of just seems like, oh, they're maybe just doing that to make it look like it's not nepotism. Okay. And then, so the audit committee agreed that Mr. Gray should be invited for an interview to be conducted by Mr. Rabi and Mr. Sterling. If Mr. Gray was found to be appointable, Mr. Rabi could proceed with the appointment. So to have a look at section 66, paragraph 4, regarding the appointments. Okay. More than that, I don't think I have to elaborate on this. Just remember principle 15 in King regarding the appointment, that should be fair and transparent. And you should always have a process of being fair and transparent, because once again, at least this seems like it's a little bit more fair and transparent than in relation to the previous scenario, because here they said at least that they tried getting someone else and then that didn't help. So then they decided to use him, but he's going for a normal interview process. So it seems like they at least tried to make it in accordance to King. So then on the first paragraph of the next page, they're talking about the auditors that realized this whole situation, and basically the auditors are no longer the auditors. And what this comes down to is you knowing that in terms of section 90, they need to fill this vacancy within 40 days. Okay, because the auditors are no longer the auditors. But this also told me a little bit about management integrity, because if you read this paragraph, there's a portion that they say, he therefore managed to persuade a number of shareholders to vote against the reappointment of the registered auditors. So management basically tried to convince the other management and say, no, let's not take these people again because of this. Okay, so then it comes into the situation where they say, given Chapman's and Chilli's failure to detect Mr. Riddle's fraudulent activities, the CEO proposed that a formal investigation be launched into their possible negligence in the performance of the audit. So now the auditors are being held liable for what went wrong, because why didn't they pick this up? Okay. So here they tell you that they basically want to keep them responsible for their negligence. But remember that they can only be held liable. Directors or the auditor's liability is only there if they did not conduct their audit in a manner that represents the IAS, if they were negligent. And could possibly have been negligence. What I thought of when I read this is, when you inspect, when you perform payroll testing, you corroborate that payment to the bank statement. What makes it difficult here is, do we know if the bank account numbers were represented on the bank statement? Did it say 2 million rand paid to him, or did it say 50,000 paid to this person, 50,000 paid to this person? But the bank account numbers just didn't reflect. So he put the right descriptions in, everything looked fine, but it was paid all to his bank account. So it is a difficult situation to assess from our point of view, because we don't have a lot more detail on that. But then part A, they said, task the head of internal audit to use whatever means necessary to obtain a copy of the 2019 audit working papers. Whatever means necessary, don't you think they'll steal it? Or they'll bribe a friend to give it to them? Or they'll go through anything to actually get those working papers? And in terms of principle 1 of King, it says that they must lead ethically and effectively. And do you think if they act in a manner that says, we would do anything that we could possibly do, that would be effectively and efficiently? So let's say, for instance, this was a situation where they're trying to manipulate their profits. They would do anything that is necessary for them to get the loan. So they need the higher profits. That does make you doubt management integrity, right? Yeah. Okay. So then a little bit lower down, under point I, it says the land to develop the new Belleville High School was purchased from Mr. Cambridge. After he disclosed his interest in the contract to the Board of Directors, and he recused himself from voting on the contract. What was not mentioned by Mr. Cambridge, however, is that he had bought the land only a few months earlier, after the need to acquire the site had been mentioned at a board meeting held in mid-2019. So he acted on information that was not publicly available to gain an advantage from it. So what do you call this? Insider trading. And he also did not act ethically because as a director, you are exposed to numerous confidential informations and you using that to your own advantage, which is not acceptable. Okay. Oh, I can't tell you off by heart what section insider trading is, but I don't think it is actually a section specifically. I think there might be a section. I'm not sure. I can have a look for you and let you know. But I don't think there's actually a specific section on that because that should probably then be under directors. And from what I remember, there's no specific section. Yes, but so the other thing that links to this is section 75, where they talk about the director's personal financial interest and how he has to disclose this and then leave the meeting. So that part of it is part of it. And I think maybe if you link insider trading to this, that's reasonable because then he's using information that's not allowed to be used for his own advantage. But I don't think there's a specific section dealing with, I don't think there is actually a specific section dealing with insider trading. I can have a look and let you know. Okay, so that was that, just the insider trading and not acting ethically. And then they said, a loan to Mr. Rabi to enable him to acquire a new house was approved by himself and the authorized representative of XY Venture Capital without a shareholders meeting being held and without the transaction being communicated to shareholders. So first of all, this should have been approved by the shareholders. This is financial assistance. Maybe he should have had a special resolution within the prior 2 years, section 45. The other thing is the board wasn't aware about this. So are they actually having ongoing oversight? Are they actually involved in the processes? It doesn't seem like it. Okay. Then this also links to section 42 in the Companies Act, where they talk about options to buy shares. Okay. So just have a look at that, read through it, be aware of it, but it's nothing major. It basically just says that if you have these shares available and there's consideration that is, let me read it to you so you can hear exactly what it is, but it's not a major section, but just be aware of it and how it can come into play. So section 42 is the option for subscription for securities. So then it says the company may issue options for the allotment or subscription of authorized shares or other securities of the company. So you are allowed to issue these options. But then a little bit later on, they tell you that the director of the company is liable to extent set out in section 77 3E III if the director was present at the meeting when the board approved the granting of the option or the rights. So this can link back to director's liability, and if they didn't approve this, they can be held liable for that. Okay. Okay, so that's that portion. Then part C of the required, I'm not going to read to you because it's regarding the negligence and the failing to detect the 2 million rand bonus, and we discussed all of that. So you can just go have a read at the memo, and if there's anything you don't understand, you can send me an email. And then part D said, based solely on the information available, discuss whether the firm of Chapman and Chile registered auditors was negligent. So that's on the same situation, but the first one goes into fraud and ISO 240, and the next one goes into reportable irregularities. Okay. And then part E, I quickly want to discuss with you because that's regarding application controls. And I feel that there is some confusion regarding application and general controls because people are confusing application and general controls. And I think the only thing that you need to realize is that general controls are everything outside of your physical application, outside your computerized system, outside your payroll system, outside of that. That's your general controls. So for instance, you say, before someone can enter the lecture hall, you actually scan your fingerprint. Okay. Or it says, before bonuses are approved, 2 people need to approve it. Or before a payment is made, 2 signatories need to go into the bank and approve the payment. So that's your general controls. Then your application controls are within your application. It's everything that happens within your application that you can get from your application. So for instance, having passwords and usernames. A general control would be your password policy, okay? But The application control is the physical entering of your password and the username before entering into the system. Then having maybe access violation. So let's say you entered your password and your username wrong for 3 times, they block your profile, and you actually need to go to the IT department and ask them, will you please give me access again because I accidentally entered it wrong. That just prevents someone from gaining access through your username. Okay. Then also having maybe a timeout. So let's say no one has used the computer for 5 minutes, it logs you out automatically, and when you come back, you have to log in again. That just helps that no one that walks past is like, oh, okay, let me quickly type in here and make sure that I change it. Okay. The other thing is alphanumerical checks, your duplication checks, extracting reports, exception reports. So exception reports that tell you, okay, this invoice has been processed twice. Or when you're actually processing an invoice again, it tells you, whoa, you've already processed this invoice. And there is actually very good systems in place that can do that, because I had a client who was busy talking to me, got busy in the conversation. When she tried to type it in again, they told her, you have already processed this invoice. Okay, so that's an application control. And then also having field checks and numerical checks. So let's say when you enter an invoice, it's usually INV001 and you enter 001. It must tell you, sorry, but it doesn't meet the requirements of this field. So that's the field check as well. And then the other thing that management and them can do, they can inspect things on a unannounced basis, logging into the system, making sure that everything is still fine, approving the reports. All of that is application controls. Okay, so just to give you an idea of that, and then general controls is everything in general outside of your application. Okay, and that's basically those tutorials for today. Thank you.